Higher government bond yields sound boring? They're not, because they quietly shape everything from your mortgage rate, to the stock market, to the value of your crypto portfolio. And near the end of this video, I'll tell you why some analysts think yields could spark the next big market rotation. When yields rise, it means governments are paying more to borrow money. Recently, the US 30-year Treasury yield peaked above 5% for the first time in years. The UK's 30-year gilt hit a 27-year high one. Japan's 30-year reached a record. These aren't just numbers, they're signals. Why does this matter? Because yields move inversely to bond prices, and higher yields ripple through the economy. For homeowners, mortgage rates climb. In the U.S., the average 30-year mortgage rate has jumped from around 6% to over 7% in past yield spikes. That means higher monthly payments and lower affordability. Housing markets slow, sellers get nervous, and buyers wait on the sidelines. For businesses, higher yields mean higher borrowing costs. Expansion plans get delayed, debt refinancing becomes painful. And for governments, it's a vicious circle. Higher yields make debt more expensive, which can push yields even higher if investors demand more risk premium. Now, here's where it hits your portfolio. Stocks, especially growth stocks, tend to suffer when yields rise. Why? Because future earnings are discounted at higher rates, making them worth less today. Tech stocks, high-growth plays, often take the biggest hit. Meanwhile, sectors like banks may benefit, as they can charge more for loans. But here's the twist. Some analysts say the market has already priced in higher for longer rates. If yields stabilize, we could see a relief rally in equities. If they keep climbing, expect more volatility, and possibly a rotation into value stocks, commodities, or defensive sectors. And don't forget crypto. Bitcoin often trades like a risk asset. When yields rise and the dollar strengthens, crypto can struggle. But if higher yields trigger equity market stress, some investors might turn to Bitcoin as a hedge. It's a complex relationship, and one worth watching closely. Now, I want to hear from you. Do you think higher yields are a temporary spike, or the start of a new era of expensive money? Drop your thoughts in the comments. I read them all, and I guarantee this one will spark debate. If you're new here, hit subscribe. We post every Tuesday and Friday, breaking down the forces moving stocks, crypto, and everything in between. Back to the story. One under-discussed effect of higher yields is on pension funds and insurance companies. They actually benefit because they can lock in higher returns on safe assets. That could shift institutional money away from riskier investments, which in turn could pressure stock valuations. Globally, rising yields in the US can pull capital away from emerging markets. That can weaken their currencies, raise their borrowing costs, and even trigger financial instability. We saw shades of this in past tightening cycles, and it's a risk again now. Looking ahead, if inflation stays sticky, central banks may keep rates elevated. That would keep yields high. But if growth slows sharply, yields could drop fast. In that case, mortgage rates might ease, stocks could rebound, and risk assets might rally. The wild card: government debt levels. With deficits still large in the US, UK, Japan, and Europe, investors may demand higher yields simply to hold that debt. Even if central banks cut rates, that's the scenario that could keep borrowing costs elevated for years. So, here's the takeaway. Higher government bond yields aren't just a bond market story. They're the quiet tide that lifts or sinks mortgages, stocks, crypto, and even global capital flows. Ignore them, and you're flying blind. Thanks for watching. If you got value from this, like, share, and subscribe. And tell me in the comments where you think yields are headed next. See you Friday for the next deep dive.